Something fundamental just shifted in the financial markets. And if you're watching this video, you likely already sense it. Silver has crossed $100 per ounce. Not in a brief spike, not in a panic-driven flash, but in a sustained move that reflects something deeper happening beneath the surface of our monetary system. This isn't about excitement. This isn't about calling a top or a bottom. This is about understanding what this moment represents, why it's different from the price movements we've seen before, and what it means for your financial decisions going forward. I'm speaking to you today as someone who has watched these markets for decades, someone who has seen cycles turn, currencies falter, and assets reprice when the world wasn't paying attention. My goal here isn't to sell you anything or convince you to act impulsively. It's to help you think clearly during a time when clear thinking matters most. If you already hold silver, you're likely experiencing a mix of vindication and uncertainty. If you don't, you might be wondering if you've missed something important or if this is just another speculative bubble about to collapse. Both groups need the same thing right now: context, perspective, and a framework for making decisions based on probability rather than emotion. So let's take a breath, step back, and examine what's actually happening in the broader financial system. Because the story of silver crossing $100 isn't really about silver at all. It's about what silver is telling us about everything else. For years, silver traded in a range that most market participants considered normal: $30, $40, occasionally pushing toward $50 in moments of stress before falling back down. Those ranges existed within a specific monetary environment: low visible inflation, central banks appearing to have control, confidence in the dollar's stability, debt levels rising but manageable, at least in the eyes of policymakers. That environment has changed, not suddenly, not all at once, but systematically over months and years. The foundations have shifted. When silver crosses a psychological threshold like $100, it's not because traders suddenly decided silver was worth more. It's because the currency silver is priced in is worth less. It's because the confidence holding together our debt-based monetary system is showing cracks. It's because real assets are repricing relative to paper claims. This matters because repricing events don't happen in isolation. When one real asset starts moving decisively higher against fiat currencies, it's usually a signal that others will follow. Gold has likely already moved. Industrial commodities are stirring. Real estate, energy, food, all begin to reflect the same underlying reality. The reality is this: we've reached the point in the debt cycle where the tools that worked before no longer work the same way. Let's talk about debt for a moment, because everything happening in silver is downstream from debt. Global debt didn't grow slowly and steadily. It exploded. Government debt, corporate debt, consumer debt, all expanded at rates far exceeding economic growth. For a time, this seemed manageable. Interest rates were low. Servicing costs were contained. The system could roll forward. But debt creates obligations, and those obligations eventually demand payment, either through productive growth or through monetary expansion. We haven't had enough of the former, so we've relied heavily on the latter. Monetary expansion means more currency units chasing relatively static amounts of real goods and assets. And when that happens, prices adjust. Not immediately, not evenly, but inevitably. Central banks tried to manage this through interest rate policy. They raised rates to combat inflation, hoping to cool demand without breaking the system. But here's the trap they're in. Higher rates make the debt harder to service. Governments pay more in interest. Corporations struggle. Consumers pull back. So what happens when debt becomes unsustainable at higher rates? Rates have to come back down, even if inflation hasn't been fully contained. And when rates come down, while debt levels remain elevated and currency creation continues, real assets reprice higher. Silver at $100 is that repricing in motion. You might be wondering why silver specifically is moving with such force. After all, gold is the traditional monetary metal. Platinum has industrial uses. Why is silver leading this charge? The answer lies in silver's unique dual nature. It's both a monetary metal and an industrial metal. It's held by investors as a store of value, but it's also consumed in solar panels, electronics, medical equipment, and advanced manufacturing. This creates a supply-demand dynamic that's particularly vulnerable to tightness. Unlike gold, which is mostly recycled and held in vaults, silver gets used up. Once it's in a solar panel or a circuit board, it's often uneconomical to recover. For years, silver traded more like an industrial commodity than a monetary asset. That kept its price suppressed relative to gold. The gold-to-silver ratio climbed to levels that historically signaled silver was deeply undervalued. But when monetary stress enters the picture, silver's monetary role reasserts itself. Investors who can't afford gold turn to silver. Those seeking leverage to monetary debasement turn to silver. And because the market is smaller and tighter than gold, the price moves can be more volatile and more dramatic. We're seeing both dynamics play out simultaneously. Industrial demand remains strong as the world electrifies and digitizes. Monetary demand is surging as faith in fiat currencies wavers. And supply hasn't kept pace with either trend. That's why silver doesn't just move higher in this environment. It can move explosively higher. Most people watching silver cross $100 will misunderstand what they're seeing. Let me address the most common misinterpretations directly. First, this isn't a bubble. Bubbles are characterized by euphoria, by everyone piling in without understanding, by valuations detached from any fundamental reality. What we're seeing in silver is a repricing based on monetary conditions and supply constraints. There's concern, not euphoria. Understanding, not blind speculation. Second, this isn't manipulation ending. For years, many in the silver community have pointed to evidence of price suppression through paper markets. Whether you believe that narrative or not, what's happening now isn't about manipulation suddenly disappearing. It's about fundamentals overwhelming whatever price management might have existed. When physical demand exceeds available supply, paper games become irrelevant. Third, this isn't simply about one country or one currency. This is about the entire architecture of the global monetary system reaching a stress point. The dollar is the reserve currency, yes, but every major fiat currency is part of the same debt-saturated structure. Silver isn't just rising against the dollar. It's rising against the concept of unlimited currency creation without consequence. Fourth, this isn't over quickly. Many people expect sharp moves to reverse just as sharply, but repricing events in monetary metals tend to unfold over years, not weeks. There will be pullbacks, there will be consolidation, but the underlying trend, once established, tends to persist until the monetary conditions that caused it fundamentally change. Understanding these distinctions matters because your response should be different from how you'd respond to a speculative bubble or short-term trade. History doesn't repeat, but it does echo, and there are echoes here worth hearing. In the 1970s, silver moved from around $2 to $50 over the course of the decade. That wasn't a straight line. It wasn't driven by manipulation or conspiracy. It was driven by inflation, currency devaluation, rising deficits, and loss of confidence in monetary policy. The circumstances then and now aren't identical, but they rhyme. Then, the gold standard had just been abandoned. Now, we're abandoning fiscal discipline entirely. Then, inflation shocked a system accustomed to stability. Now, inflation is proving more persistent than authorities promised. Then, as now, real assets repriced higher while paper assets struggled. Stocks had a difficult decade in real terms. Bonds lost purchasing power. But commodities and hard assets preserved and grew wealth for those positioned correctly. The lesson isn't that history will repeat exactly. It's that certain conditions produce predictable outcomes. When debt levels are unsustainable and currency creation accelerates, real assets outperform paper claims. It happened in the 1970s. It happened in the 1940s. It happened in Weimar Germany, in Rome, in every civilization that tried to print its way out of debt. Silver at $100 isn't the end of this pattern. It's likely closer to the beginning. We should also remember what happened after the 1970s. Silver eventually peaked and crashed. The monetary system was restructured under Paul Volcker. Interest rates soared. Inflation was wrung out of the system through painful recession. And for the next 4 decades, financial assets outperformed real assets. That cycle will come again, but not yet. Not while debt continues to grow faster than the economy. Not while central banks remain trapped between inflation and insolvency. If you're watching this and you already own physical silver, you're likely feeling a complex mix of emotions right now. Relief that your patience is being rewarded. Anxiety about whether to sell. Uncertainty about what comes next. Let me offer you some perspective grounded in probability rather than prediction. First, recognize that you weren't wrong to hold silver, even when it seemed like nothing was happening. You understood something important about monetary risk that most people dismiss. That understanding has value beyond the current price. Second, understand that strong moves in either direction can be disorienting. Your natural instinct might be to lock in gains, to sell some or all of your position. That's not wrong, but make sure you're selling into strength for the right reasons, not out of fear or disbelief. Ask yourself, what has changed about the fundamental reasons you bought silver? Is global debt lower? Is currency creation slowing? Have central banks found a way to raise rates without breaking the system? If the answer is no, then the case for holding remains intact. Third, consider that this move might still be early in a longer repricing cycle. Silver at 100 might feel high compared to where it was, but measured against the expansion of the money supply, against the scale of debt, against the debasement of purchasing power, $100 per ounce might still be undervalued. That said, no one should be 100% allocated to any single asset. If your silver holdings have grown to represent an uncomfortably large portion of your wealth, rebalancing makes sense. Take some gains, diversify, reduce risk, but do it systematically, not emotionally. Most importantly, if you hold physical silver, continue to hold it physically. Don't be tempted to trade it for paper promises or complex financial instruments you don't fully understand. The whole point of holding real assets is to be outside the fragile paper system. Don't re-enter that system now, just as its vulnerabilities are being exposed. Now let's address those of you who don't own silver, who might be watching this move with a mixture of regret and curiosity. The first thing to understand is this. You haven't necessarily missed the opportunity, but you have missed the safety of buying when no one cared. Buying at $100 carries different risks than buying at $20. The potential upside may still be substantial, but the potential for volatility is also higher. The question you need to ask yourself isn't, should I chase this price? But rather, do I understand and accept the risks that made silver investors buy when it was less popular? Those risks include holding an asset that doesn't pay income, doesn't generate cash flow, and can be volatile in the short term. They include accepting that you might buy and watch the price fall 20% or 30% before it ultimately goes higher. They include the possibility that you're wrong about the monetary thesis, that central banks find a way to stabilize the system, and real assets underperform for years. If you can accept those risks, if you understand the reasoning behind holding real assets during monetary instability, then establishing some position might make sense, but do it gradually. Don't bet everything on silver at $100 being cheap in hindsight. Scale in over time. Average your cost. Give yourself room to be wrong in the short term while positioning for being right in the long term. Consider also that silver isn't the only option. Gold offers similar monetary protection with less volatility. Other real assets, from productive land to essential commodities to high-quality businesses with pricing power, also offer ways to preserve purchasing power during currency debasement. The worst thing you can do is nothing because you feel you've missed your chance, then panic buy at a much higher price when the move accelerates further. Educate yourself now. Understand the landscape. Make small, thoughtful moves rather than large, emotional ones. And crucially, if you decide not to buy silver at all, that's also fine. Not everyone needs to hold physical metals, but everyone needs to understand what silver's move is telling us about the monetary system, because that affects every financial decision you make, whether you own silver or not. Let's talk about how markets actually behave during significant repricing events, because understanding psychology matters as much as understanding fundamentals. Markets don't move in straight lines, even in powerful bull markets. Prices oscillate, consolidate, and occasionally reverse sharply. This is normal. This is healthy. This is how markets shake out weak hands and test conviction. What you should expect going forward. Periods where silver surges rapidly, followed by corrections that feel devastating but don't break the underlying trend. Media attention will amplify both the rises and the falls. You'll hear predictions of silver going to $500. You'll hear predictions of it collapsing back to $50. Most of these predictions will be noise. The psychology of a repricing event follows a pattern. First comes disbelief, what we've mostly seen until now. Then comes awareness, where we are currently. Next comes enthusiasm, where mainstream investors start paying attention. Then comes euphoria, where everyone believes prices can only go higher. Finally comes the top, followed by a brutal correction that wipes out those who bought with emotion rather than understanding. We're probably somewhere between awareness and enthusiasm. That means there's likely significant upside remaining, but also increasing volatility and risk as the move matures. Your job as a thoughtful investor isn't to predict where we are in this cycle with precision. It's to manage risk appropriately for whichever phase we're in. That means not being fully invested at any time, not being completely out at any time, and continuously reassessing as conditions evolve. It also means ignoring much of the noise on social media and in financial news. You'll see people claiming they predicted this exact move, calling for dramatically higher prices without nuance, or declaring victory prematurely. You'll see others dismissing the entire move as temporary, as manipulation, as a bubble about to burst. Both extremes are usually wrong. Reality is nuanced. The truth is usually that we're in a structural shift driven by identifiable forces. But the path will be volatile and uncertain, and no one knows precisely where prices will be in 6 months or a year. Now I need to be very direct with you about what not to do, because this is where people make costly mistakes that can undo years of prudent behavior. Do not leverage your silver position. Do not borrow money to buy more silver because you think it's going higher. Do not use margin, futures, or options unless you are an experienced trader who fully understands the risks. Leverage turns volatility into account-destroying losses, and silver is volatile even in bull markets. Do not sell everything you own to go all in on silver. Diversification isn't cowardice, it's wisdom. No matter how compelling the thesis, no matter how strong the trend, concentrated bets carry concentrated risk. Keep balance in your portfolio and your life. Do not blindly follow influencers or personalities telling you to buy specific products or use specific dealers without doing your own research. There are good people in this space, but there are also opportunists who will take advantage of your excitement or fear. Verify everything. Trust, but verify. Do not make financial decisions based on emotion. If you feel euphoric, you're probably near a local top. If you feel despairing, you're probably near a local bottom. Neither feeling is a reliable guide. Have a plan. Follow your plan. Adjust your plan based on changing conditions, not changing emotions. Do not ignore your personal financial situation. If you have high interest debt, if you lack an emergency fund, if you're not meeting basic financial obligations, silver isn't your answer right now. Fix your foundation first. There's always another opportunity for those who are prepared. Do not expect silver to solve all your financial problems overnight. It's an asset. It's a form of insurance. It's a way to preserve purchasing power. It's not a lottery ticket. It's not a get-rich-quick scheme. Treat it with the seriousness it deserves. Do not forget about security. If you hold physical silver and its value has increased dramatically, you're now a more attractive target for theft. Don't talk publicly about your holdings. Store them securely. Consider insurance. Think about safety as seriously as you think about profits. And finally, do not stop educating yourself. Markets evolve. Conditions change. What worked yesterday might not work tomorrow. Stay curious. Stay humble. Stay flexible. We've covered a lot of ground in this video. Silver crossing $100, the debt trap, monetary debasement, historical patterns, what it means for holders and non-holders, psychology, warnings. But I want to end by bringing this back to the bigger picture, because that's what matters most. Silver's price is just a number. What that number represents is far more important. It represents a loss of confidence in the paper monetary system that has defined the last several decades. It represents a return to understanding that real things have value independent of what governments and central banks promise. This isn't the end of the world. This isn't a collapse into chaos, but it is a transition, and transitions are uncomfortable. They require us to question assumptions we took for granted. They force us to think differently about risk and value and wealth. Your job during this transition isn't to become a silver fanatic or a doom predictor. It's to stay informed, stay rational, and stay prepared. It's to understand that the rules of the last 40 years, where financial assets always outperformed, where debt didn't matter, where central banks could always save the day, might not be the rules of the next decade. The investors who do well in the coming years won't necessarily be the smartest or the most aggressive. They'll be the ones who understood the change that was happening, who positioned themselves thoughtfully, and who maintained emotional discipline when everyone around them was panicking or euphoric. They'll be the ones who remembered that wealth isn't about betting everything on one outcome. It's about preparing for multiple scenarios, managing risk intelligently, and adapting as conditions evolve. Silver at $100 is significant, but it's just one data point in a much larger story. The story of what happens when decades of monetary experimentation reach their limits. The story of how markets adjust when imbalances become unsustainable. The story of how thoughtful people protect and grow wealth during times of systemic change. You don't need to know exactly what happens next. No one does. What you need is a framework for thinking clearly, a commitment to ongoing education, and the emotional discipline to stick to sound principles when everything feels uncertain. If you take nothing else from this video, take this. Understand the cycle you're in, respect the risks you're taking, and never stop learning. The markets will continue to evolve. Your understanding needs to evolve with them. Silver has given us a clear signal. Something has changed in the financial landscape. How you respond to that change matters far more than the price of silver on any given day. Stay thoughtful, stay disciplined, stay educated, and remember that the goal isn't to get rich quick. It's to preserve and grow wealth steadily over time, no matter what the monetary system throws at you. Thank you for watching. Think carefully, act wisely, and I'll see you in the next video.